Imagine a basketball season ends, the final buzzer sounds, and someone walks over and resets the scoreboard to 0-0. Is that a crime? No, that's how seasons work. The scoreboard measures one season. But here's the thing, the trophy case is never reset. The wins live there forever. Tonight, accountants do exactly this. We take every revenue account, every expense account, everything Maplebean fought for all year, and we erase them, on purpose, back to zero. Because those accounts are scoreboards, and a new period deserves a fresh score, where do the results go? Into the trophy case, an account called Owner's Capital, where they live forever. This is closing the books, the most satisfying chapter in accounting. Stay to the end. The whole chapter is on one card you can screenshot. First, the homework. On September 1st, a company pays $8,400 for a 12-month insurance policy, and Chapter 3 asks you for the December 31st adjusting entry. Same shape as Maplebean's own policy. The asset expires one slice at a time. The arithmetic first. 8,400 over 12 is 700 a month, and September through December is 4 months, so 2,800 has expired. December 31st, debit insurance expense $2,800, credit prepaid insurance $2,800, one income statement account, one balance sheet account, and no cash, both golden rules obeyed. If you wrote that, you are ready for tonight. The map, one more time, and tonight, the map gets sharper. Analyze, journalize, post, trial balance, adjusting entries, adjusted trial balance. And now look at step 7, because this one hides in plain sight. Prepare the financial statements. Why haven't we been shouting about it? Because you already lived it before you ever saw this map. Chapter 1, built the income statement, the owner's equity statement, the balance sheet. And Chapter 3's big reveal, the profit that vanished, that was an income statement catching the books in a lie. The statement's official home in the cycle is right here, prepared straight from the adjusted trial balance. 7 steps, conquered. Tonight, Step 8, closing entries, and Step 9, the post-closing trial balance. The final 2, and one detail examiners love. Closing entries happen only at the end of a company's accounting period, and for most companies that means once a year. We adjust monthly or quarterly. We close annually, at the end of the fiscal year, and many companies pick a natural business year, one that ends when activity is at its lowest, which is why so many retailers close in January. Maplebean is 1 year old, and tonight is December 31st, the end of its fiscal year, so we close its very first year. And every mechanic you're about to see is identical whether the period is a month or a year. Before we erase anything, we need to know what gets erased. 1 table, 2 columns. Column 1, permanent accounts, the trophy case, also called real accounts. Assets, liabilities, owner's capital. These are carried forward from period to period, not closed, ever. Your cash doesn't evaporate on January 1st. Column 2, temporary accounts, the scoreboards, also called nominal accounts. Revenues, expenses, and owner's drawings. These measure one period only, and at period end, all of them go to 0. And the how is already in your hands from Chapter 2. Every expense account carries a debit normal balance, so to empty an expense, you hit it with a credit of the same size. Revenues live on the credit side, so they take a debit. The whole chapter is this table: permanent, keep, temporary, close. Let me tell you something from my teaching days. Every time my class reached closing entries, I watched the same movie, students memorizing 4 entries, praying, hoping the exam would be kind. So I started doing one thing differently. I'd put the expanded accounting equation on the board and say, stop memorizing, look. Assets equal liabilities plus owner's capital minus owner's drawings plus revenues minus expenses. Look at the right side. Capital is permanent. And notice, so is the whole left side. Assets and liabilities carry forward too. Every balance sheet account survives the reset. But drawings, revenues, and expenses are just temporary sub-accounts of equity, little buckets we used during the period so we could see the details. At period end, every one of them flows home. Revenues minus expenses gives net income, and net income increases equity. A net loss decreases equity, and drawings decrease equity. Closing is not destruction. It's the temporary accounts pouring their contents back into owner's capital, where they belonged all along. Pause and sort these 6, permanent or temporary. 1. Cash. 2. Service revenue. 3. Accounts payable. 4. Rent expense. 5. Owner's drawings. 6. Accumulated depreciation. Careful with the last one, it's sneaky. Cash, permanent, it's an asset. Service revenue, temporary, close it. Accounts payable, permanent, a liability. Rent expense, temporary, close it. Owner's drawings, temporary, close it. And accumulated depreciation, permanent. It's a contra asset. It rides with equipment period after period, remembering everything used up. The used up meter never resets. Depreciation expense closes. Accumulated depreciation never does. If you got that one, you really understood Chapter 3. Meet a strange new account. Income summary. It exists for one job on one day of the period and then it disappears again. It's a funnel. All revenues pour in one side, all expenses pour in the other, and what remains at the bottom is net income or net loss. One clean number. Then the funnel empties into owner's capital and goes back to zero. Two facts to lock in. Income summary never appears on any financial statement, and it's only used during closing. It's the accountant's mixing bowl, used, washed, put away. Now Maplebean's real books, December 31st, closing time. Entry 1, close revenues to income summary. Maplebean's service revenue holds $22,650. A credit balance, straight off your adjusted trial balance. To empty a credit balance account, we hit it with a debit of the same size. Debit service revenue, $22,650. Credit income summary, $22,650. Watch the T account. The revenue scoreboard reads 0, and the funnel now holds $22,650 on its credit side. Entry 2. Close all expenses to income summary. One compound entry, and the table shows all 6. Debit income summary for the total, $16,290. Then credit each expense to empty it. Rent expense, $4,800. Salaries and wages. Expense, $6,650. Supplies expense, $2,900. Insurance expense, $660. Depreciation. Expense, $1,200. Interest expense, $80. Add them, $16,290. And it matches the debit exactly because it must. 6 scoreboards. All 0. The funnel now holds revenues on one side, expenses on the other. A compound entry is where most beginners tap out. You just read one straight through, line by line. Entry 3, and here the road forks, so we table both versions. Version A, net income. Income summary has a credit balance, close it with a debit. Debit income summary, credit owner's capital, equity grows. Version B, net loss. Income summary has a debit balance, close it the other way. Debit owner's capital, credit income summary, equity shrinks. And Maplebean, revenues $22,650, expenses $16,290, so the funnel holds a credit balance of $6,360. Net income, and you've met that number before. It's the profit from the end of Chapter 3, and it arrived here by itself. So, debit income summary, $6,360. Credit owner's capital, $6,360. The truth from Chapter 3, now stamped into the trophy case. Now, before I show you Entry 4, make a prediction. Where did drawings go? Through the funnel like the revenues and expenses, or somewhere else? Hold that answer. The next entry settles it. Entry 4. Close owner's drawing straight to capital. Drawings carries a debit balance of $1,000, so credit it to empty it. Debit owner's capital $1,000, credit owner's drawings $1,000. And say the trap out loud because it appears on every exam. Drawings never go through income summary. Never. From my teaching days, I can tell you exactly what this trap costs. Every winter, I graded a mountain of closing questions, and every winter, a chunk of the class ran drawings through the funnel and lost the same easy marks. One student wrote in the margin, but it felt like an expense. That feeling is the trap. Drawings are not an expense. They don't measure performance. They're the owner reaching into the business pocket. Income summary measures the season. Drawings skip the season entirely and hit the trophy case directly. Now the whole closing. On one board, every temporary account from the adjusted trial balance is up here, each in its own T account, carrying the balance it earned all year. And in the middle, income summary. But why does that funnel exist at all? Why not sweep everything straight into owner's capital? Because the trophy case deserves one honest line, not 7 raw numbers dumped on top of it. Now, watch the board work with the one rule that makes every closing entry obvious. To empty an account, hit it with an equal blow on the opposite side of its normal balance. Entry 1, tagged C1. Service revenue lived all year on the credit side. Credit is its normal balance, so we do the opposite. Debit service revenue $22,650. The revenue T reads 0. Entry 2, tagged C2. Every expense lives on the debit side, so credit each one to 0. 6 of them, and debit income summary $16,290 for the total. 6 scoreboards, 6 check marks. Entry 3, tagged C3. Look inside the funnel. Credits $22,650. Debit $16,290. Credits are greater, so income summary holds a credit balance of $6,360, a profit. Same rule to close it. Opposite side, debit income summary $6,360 and credit owner's capital because profit grows the trophy case. The funnel reads 0, used, washed, put away. And entry 4, tagged C4, drawings never touches the funnel. Owner's drawings carries a debit normal balance, so credit it $1,000 to close it, and debit owner's capital $1,000. Now look at the board. Every scoreboard reads 0. Every temporary line on the adjusted trial balance is checked off, and owner's capital settles at $17,360. $12,000 to start plus $6,360 minus $1,000. Every tag on that board points back at the entry that made it, which is exactly how an auditor walks backwards from a balance to its source. If you followed that whole board, end to end, take a second to notice what you just did, because somewhere in this audience, a future CFO just closed their first set of books. One rule carried the whole night. Normal balance, opposite blow, 0. Here it is, Maple Bean post-closing trial balance, December 31st. Debits, cash $11,200, accounts receivable $4,350, supplies $1,100, prepaid insurance $1,980, equipment $9,000. Credits, accumulated depreciation $1,200, accounts, payable $1,940, notes, payable $6,000, unearned service revenue $600, salaries and wages, payable $450, interest payable $80, owner's capital $17,360, the new figure, not the old $12,000. Totals, $27,630 equals $27,630. Now look at what's missing. Service revenue, gone. All 6 expenses, gone. Drawings, gone. Scoreboards at 0, ready for year 2. Your turn. A different shop, so fresh numbers, and its year just ended. Service revenue, $9,800. Expenses, salaries $5,200. Rent $1,900. Utilities $950. Drawings $700. Beginning capital, $15,000. Write all 4 closing entries and compute the ending capital. Pause, use the diagram. 1. Debit service revenue, $9,800. Credit income summary, $9,800. 2. Debit income summary, $8,050. Credit salaries $5,200. Rent $1,900. Utilities $950. 3. The funnel holds $9,800 credit minus $8,050 debit, $1,750 of net income. So, debit income summary $1,750. Credit owner's capital $1,750. 4. Debit owner's capital $700, credit drawings $700. Ending capital $15,000 plus $1,750 minus $700, $16,050. 4 entries, you just closed a full set of books. Step 9. The final checkpoint, the post-closing trial balance. One rule decides who appears on it. Survivors only. Assets, liabilities, and owner's capital. Its job is the same proof as always. Debits equal credits, but taken after the closing sweep, so the new period starts from a verified, clean baseline. Think of it as the handover document. Year 1 signing the books over to year 2, and the same old limitation still applies. A missing entry, a doubled entry, or the right amount in the wrong account will all still balance. Proof of arithmetic, never proof of truth. And if the hunt does turn up a real error, you already know the repair. It's the correcting entry from Chapter 2, one move to put the amount on the page where it belonged. Now the table that sums up 3 chapters, side by side. Column 1, Chapter 2's trial balance, $42,440. Balanced, but remember, quietly wrong. Supplies claimed $4,000 when the closet held $1,100. No depreciation. Unbilled work missing. Unpaid wages missing. Column 2, Chapter 3's adjusted trial balance, $44,920. Every stale number dragged back to reality. This one is true, but it's crowded, temporary, and permanent accounts mixed together. A whole season's scoreboard still on the page. Column 3, tonight's post-closing trial balance. 27,630. True and clean. Only the permanent accounts. The scoreboard's emptied into capital. Ready for a new period. Watch the story in the totals. Balance but lying, then true but crowded, then true, clean and closed. Look at the map now. Analyze, journalize, post, trial balance, adjust, adjusted trial balance, prepare the financial statements, close, post-closing trial balance. 9 steps, 9 green check marks, and the arrow loops back to step 1, because January is already coming. You've now walked the entire accounting cycle with one shop, Maplebean, from its first dollar to a clean closed set of books. 4 chapters ago, you didn't know what a debit was. Tonight, you close the books. Let that land for a second, then part 2, because this chapter has one more gift. The post-closing balance sheet works, but it's a junk drawer. Cash next to equipment next to a bank loan, everything in one pile. Real companies publish a classified balance sheet, the same accounts, grouped together with similar items, like organizing the drawer into labeled trays. Why bother? Because the groups answer questions the pile can't. Can this company pay its bills this year? Can it survive long term? We'll meet those questions properly in a moment. Screenshot this table, the skeleton of every classified balance sheet on Earth. Asset side, 4 groups in order. Current assets, long-term investments, property, plant and equipment. Intangible assets. Liability side, 2 groups. Current liabilities, then long-term liabilities. And at the bottom, owner's equity. One note before we tour each tray, the balance sheet still represents the basic accounting equation. Assets equal liabilities plus equity. Classification changes the order, never the math. Current assets. Assets expected to be converted to cash or consumed within 1 year, or the operating cycle, whichever is longer. And they're listed in order of liquidity, how fast they become cash. From my teaching days, the question I heard every single year was, who decided this order? Nobody did. It is just how fast each item melts into cash, and the struggling student who finally renamed it the melting list, ice at the top, stone at the bottom, never missed it again. Cash and cash equivalents first, treasury bills, commercial paper, money market funds, then trading securities, stocks and bonds held for sale, carried at fair value, notes receivable, written promises to pay, accounts receivable, inventory, supplies, and prepaid expenses, carried at historical cost, fair value for the traders, historical cost for the rest, 2 price tags, 1 tray. That phrase, or the operating cycle, whichever is longer, deserves one slide. The operating cycle is the average time between acquiring materials or services, selling the product or service on account, and collecting cash from customers. Buy flour, sell bread on account, collect. 2 clocks inside it, days sales and inventory, and days sales outstanding. For most businesses, the cycle is shorter than a year, so the 1-year rule governs. But a shipbuilder or a winery, their cycle can run years, and that becomes the yardstick. And if an entity has no clearly defined operating cycle, the 1-year rule governs. Long-term investments, things the company owns but is not using in its operations. The table. Land or buildings held for speculation, waiting to be sold, not producing. Investments in stocks and bonds of other companies, held for more than 1 year. And long-term notes receivable. The test is purpose. If it's parked capital rather than a working tool, it lives in this tray. Property, plant, and equipment, also called fixed assets or plant assets. The working tools, machinery, delivery equipment, furniture, buildings, land, each shown the Chapter 3 way. Cost minus accumulated depreciation equals net book value, also called carrying value, except one resident of this tray, land. Land is not depreciated, ever. Machines wear out, buildings age, land just sits there, outliving us all. Favorite exam trap, now yours. The last asset tray, intangible assets. No physical substance, represented by a piece of paper, yet sometimes worth more than every machine combined. The table. Patents, copyrights, trademarks, and trade names, which is what your Maplebean name and logo become the day you register them. Goodwill. You can't drop a trademark on your foot, but try buying a famous brand name and see what it costs. Value doesn't need a shape, neither does the skill you are stacking here, chapter by chapter, and it compounds just the same. Sort these 6 into the 4 asset trays. Pause. 1. A delivery van. 2. A patent. 3. Inventory. 4. Land the company operates its factory on. 5. Land held for speculation. 6. Shares of another company, held for 5 years. Careful, land appears twice, and the 2 answers are different. delivery van, property, plant and equipment, patent, intangible, inventory, current asset, factory land, property, plant and equipment. And remember, never depreciated. Speculation land, long-term investment. It's parked, not working. Shares held 5 years. Long-term investment. The same item can change trays. Purpose decides. Flip to the other side. Current liabilities, obligations the company will pay within 1 year, or the operating cycle, whichever is longer, from the balance sheet date. The table, notes payable, accounts payable, salaries and wages payable. Unearned revenues, our debt of services from Chapter 3, and that's exactly where the gift card money lives. Interest payable, income taxes payable, and the sneaky one, current maturities of long-term obligations. That last one, the slice of a 20-year mortgage that's due this year, moves into the current tray. Debt migrates as its due date approaches. Long-term liabilities, obligations expected to be paid after 1 year. The table, long-term notes payable, mortgages payable, lease liabilities, pension liabilities, other non-current liabilities, and beneath it all, owner's equity, the residual claim, the net assets. Its story in statement form. Beginning capital, add investments and net income, less drawings and net loss. Ending capital, Maplebean's own version, $12,000 plus $6,360 of net income, less $1,000 of drawings, $17,360. And for a corporation, this section is called stockholders' equity. Same idea, different name. Why did we do all this sorting? Because now, 3 questions, 3 answers, 1 table. Question 1, liquidity risk. Can the company pay its short-term liabilities? Compare current assets to current liabilities. Question 2, solvency risk. Can it pay its long-term liabilities? Will it survive? Look at long-term debt against everything it owns. Question 3, capital structure. What's the company's financial risk? The mix of debt and equity financing. Who really funds this business? Creditors or the owner? 3 questions every banker, investor, and future CPA asks, and the classified balance sheet answers them at a glance. This is the bridge to real financial analysis, exactly where this channel is heading. And now, Maplebean graduates. December 31st, the formal 3-line header, classified. Current assets, cash $11,200. Accounts receivable, $4,350. Supplies, $1,100. Prepaid insurance, $1,980. Total, $18,630. Property, plant and equipment, $9,000. Less accumulated depreciation, $1,200. Net book value, $7,800. Total assets, $26,430. Current liabilities, accounts payable, $1,940. Unearned service revenue, $600. Salaries and wages payable, $450. Interest payable, $80. Total, $3,070. Long-term liabilities, the banknote is a 3-year note, so all $6,000 of it sits down here. Owner's capital, $17,360. Liabilities plus equity, $26,430. And now answer question 1 with real numbers. Working capital, current assets minus current liabilities, $15,560 of cushion. The current ratio, 18,630 over 3,070, about 6.1 to 1. $6 of short-term assets for every dollar due within the year. Balanced, classified, closed, and completely provably true. And you built every number in it. Last exam of the cycle. Pause. 1. A year from now, Maplebean's service revenue is $9,300 at period end. Write closing entry number 1. 2. Classify these 3. A mortgage payable due in 15 years, the unearned gift card revenue, and a trademark. 3. True or false? Owner's drawings is closed to income summary. You know the trap. 1. Debit service revenue, $9,300. Credit income summary, $9,300. 2. The mortgage, long-term liability, unearned revenue, current liability, the work is owed soon, the trademark intangible asset. 3. False. Drawings close directly to owner's capital, never through income summary, because drawings are not an expense. If you nailed all 3, the entire accounting cycle is yours. And that skill of reading a company in trays, liquidity up top, claims ranked, equity at the base, is exactly how a future portfolio manager sizes up a balance sheet, and you just did it from memory. Lock it in, the Chapter 4 cheat card. The closing river at the top, revenues and expenses flowing into the income summary funnel, the funnel emptying into capital, and drawings bypassing everything, straight to capital. The permanent versus temporary test underneath, keep or close, the 4 entries numbered with Maplebean's own figures, and the classified balance sheet skeleton on the side, 4 asset trays, 2 liability trays, equity at the base, with the 2 traps stamped in gold. Land is never depreciated, and drawings never touch income summary. Pause, screenshot, camera roll exam day. That's Chapter 4, and that's the entire accounting cycle. 4 chapters, 1 shop, from your first $10,000 to a closed, classified, honest set of books. You're not learning accounting anymore, you're doing it. But here's the cliffhanger. Maplebean sells a service. What happens when a company sells things? Inventory arrives, freight bills, discounts, returns, and a brand new account called Cost of Goods Sold that changes the whole income statement. Merchandising, Chapter 5, where accounting meets the real economy. Your homework, and I'm not solving this one. A brand new company begins its year with capital of $9,400. It earns $5,300 in revenues, pays $3,900 in expenses, and the owner withdraws $250. What is the ending capital balance? The worked answer is with the free notes, exercises, and mock exams at appliedanalyst.com, link below. Tell me in the comments exactly where anything lost you. I read everyone, because I want you to hear this clearly. You're not just watching videos. You're building the foundation that future CPAs stand on. Some of you watching tonight will sign audit opinions one day, and you'll remember that it started here, with a T account and the decision to keep showing up. Tonight, you finish the entire foundation. See you in Chapter 5. The scoreboard is reset. The season starts again.